With the rising cost of healthcare, most of us are looking to save money on our healthcare cost where we can and save on taxes at the same time. Today we're going to look at the triple tax advantaged health savings account HSA and the health flexible spending account FSA. We'll look at what they are, who is eligible to open one, and how they can save you money each year. HSAs and FSA both use pre-tax dollars to pay for qualified medical expenses that health insurance doesn't cover. This means that contributions to these accounts reduce your taxable income. You can choose to fund the account with payroll deductions. But a nice perk is that your employer can also fund the account. The employer's contributions are also not taxable. The IRS tax distribution from these accounts if they are not used to pay qualified medical expenses. Qualified medical expenses are anything used to diagnose, cure, or prevent disease. The Coronavirus Aid, Relief and Economic Security Act added things like menstrual products and over-the-counter medications to the list of eligible expenses. This means that you can use tax-free funds to purchase things like allergy medicine, cough and cold medication, ibuprofen, lip balm. You can get your deduction for HSA and FSA contributions even if you do not itemize deductions on your tax return. It is also important to note the expenses paid for by your HSA or FSA are not eligible for the itemized medical expense deduction. Both the HSA and FSA typically reimburse individuals for their qualified expenses. Although some account administrators give their clients a card like a debit card to make purchases, the burden of proof that the expenses are eligible falls on the taxpayer. Let's say that Bob has a doctor's appointment and his copay is $40. He can use his HSA to pay for that since his insurance doesn't cover it. On the way home, he stops by the pharmacy to pick up his medication that has a $100 copay. Before he leaves, he remembers to pick up some menstrual products for his daughter, which cost $10. Bob will keep his receipt and turn them into his account administrator. The administrator will reimburse him with funds from his HSA. This would work the same way if he had a healthcare FSA. The HSA and FSA have more differences than they do in common. Let's look at what you should consider when looking at the two accounts or if you qualify. What's the difference between an HSA and an FSA? One main difference between the two accounts is ownership. A taxpayer owns and controls their HSA account. They determine how and when they will make contribution to the account. They can change the contribution amounts as long as they stay under the IRS limits for the year. This means that HSAs are available to you if you are self-employed. A taxpayer can open an HSA on their own if they are self-employed or employed. The account is also considered portable. This means that you get to take it with you when you change jobs or retire. An employer owns and maintains an FSA. The amount the taxpayer wants to contribute also must be set at the beginning of the year. FSA accounts are not portable. If you have an FSA and leave your job, then you will also be leaving the money in that account. The same is true for what is not used by the end of the year. FSA funds are use it or lose it. This means at the end of the year, if you have $300 left in your FSA account, your employer has three options. Option 1, too bad, so sad for you, and the funds go back to the employer. Option 2, they can give you 2.5 months to file a reimbursement claim. Option 3, let the $300 roll over to the next year. You are pretty much at the grace of your employer. It is important for you to find out the policy before choosing an account. On the other hand, the funds from an HSA automatically roll over every year. This means the balance can continue to grow. The interest that accrues is also tax-free, which is why it is a triple tax advantaged plan. Its contribution is tax-free, it grows tax-free, and when properly used, the distributions are tax-free. You can choose to invest the money in your HSA account to have it grow. After age 65, you can pull your HSA funds tax-free regardless of the reason. If you do this before 65 though, you will pay taxes on the distribution and pay a 20% penalty. FSA owners do not have this option because the funds are gone at the end of each year. There's no time for them to grow or roll over to retirement age. To qualify for an FSA, your employer must offer the account as well as a traditional healthcare plan. It cannot be a plan that you purchase through the marketplace. There are different types of FSA accounts. Health FSAs have a contribution limit of $3,200. To qualify for an HSA, you must also have a high deductible health plan, HDHP. This plan has lower insurance premiums, but the amount you pay out of pocket before insurance kicks in will be higher. The contribution limits for an HSA depends on your age and the type of insurance coverage you have. For 2024, individual HSA contributions are $4,150 and family HSA contributions are $8,300. If you're 55 or older, you can contribute an extra $1,000 each year. IRS call this a catch-up contribution. For a family plan, only one member of the family must be 55 or older. In summary, when considering a health savings account or flexible spending account, you should consider more than the potential tax savings. That's an extra bonus. You should consider how healthy you are now. Having a high deductible health plan isn't ideal if you have to go to the hospital or doctor often. An FSA is not ideal if you won't use all your funds within a year. Choosing one will depend on your eligibility and savings plan. Now you know how to make the best choice for yourself.